Hello everyone, thank you for joining us today in this Angeles Foundation webinar. Today we're going to talk about a very interesting topic, personal finance for future angel investors. To all those that are interested in being future angel investors backing up the highest growing startups, this is the session for you. But before we begin, I want to briefly introduce the Angeles Foundation. Angeles Foundation is the philanthropic arm of Angeles Investors. The Angeles Foundation is a Chicago-based nonprofit organization focused on socioeconomic empowerment through educational programming, and the foundation provides resources to prospective investors, community members, and startup founders. And with that, we do webinars on investment fundamentals, due diligence, risk assessment, and entrepreneurship. But today's session, the personal finance for future angel investors, is part of that mission, helping more people build the knowledge, confidence, and discipline to better understand the early stage investment. And with that, I want to welcome everyone to this webinar. This is part of our new series, the Capital Fluency series. And it's about before someone begins investing in startups, they need to understand how private market really and investing fits into their broader financial life. If it's today's conversation will focus on the financial foundation that should come first: liquidity, savings discipline, risk tolerance, long-term planning, and determine how much capital someone can possibly commit to an illiquid and high-risk asset such as venture capital. And today, to begin, I want to introduce a couple great speakers and Angeles members, co-founder and Angeles members, one of here, chair in the portfolio as well, in here in the Angeles community. I want to introduce Adela Cepeda. Thank you for joining us, co-founder and chair of Angeles Investors and general partner in our fund, Angeles Ventures. She's a corporate director at BMO Financial Group, or BMO US, Bank of Montreal, for those that know it like that. And Adela serves in multiple boards, including Mercer Funds, Pathway Funds, UBS Funds, and the list goes on and on. So thank you for joining us, Adela.
Oh, it's a pleasure to be here.
And our second speaker, Carlos Méndez, he will be joining us. He's director of Fusion Works, and he's the chair of our portfolio management at Angeles Investors. Carlos previously spent 9 years in MetLife Global Internal Audit Leadership Team, and he brings extensive experience in finance, governance, and early stage investment. So thank you, Carlos, for joining us.
Yeah, absolutely. Thank you so much.
Perfect. So now let's get into topic. Great speakers we have here. Thank you both for joining us. Today we're here to talk about these personal finance for future angel investors. And before we start, I want us to dig in a little bit into what financially ready actually means. So I have a question. First question for both of you is, before someone considers making their first angel investment or private equity investment or this private asset class investment, what should be true about their personal financial situation? Where do they need to be? And Adela, if you want to start with that question.
Thanks for that question. Uh, to be honest, many of us are forced or asked to make financial decisions before we're ready, before we're prepared. And what I mean is, when you have a job with a large corporation, you're immediately asked whether you want to start a 401k plan. And that's a very smart thing to do. It's in addition to your IRA, you have a 401k, and you say yes. And then you are handed a whole menu of of possible investments that you can select for your savings. And right there, you could be, it's your first day out of school and you got the job, and that's one of the forms you have to fill out. So I think it's a timely conversation because you have to be prepared even if you're not financially ready. You have to think about what you're doing.
Carlos, what about you? What should be true about their personal finance situation?
Um, I would say really understand your situation financially in the now and in the future, and also in terms of financially your personal desire. Some people will call it the appetite, some people will call it tolerance, but your personal aspect on how your financial finances and your personal mindset adapt and is ready for that. I'm going to what Adela said for, and to give you a little bit of context, for 25 plus years I was in corporate, and I operated saving a lot, or trying at least, and being a very aggressive saver and an investor through the corporate alternative, right, like public market and some real estate. And when I left corporate in 2019, it was a moment of introspection as to what I wanted to do next and what I needed to do for what we call this, the next phase in my finances, my family finances. So that took me the step of looking at things like a CFO, like a chief financial officer for the family, and think about the allocation of capital and savings.
So
Perfect.
back to that. So you started, you have the form to fill out, and you're 22 years old, 23 years old, and you say, what should I do? I'm very risk averse. I think I'm just going to keep my money in treasuries. Okay. While there is a risk component to every investment strategy, what you should be thinking about if you're, under 40, say, is, well, I don't have to retire for 25 years. Or I can't, or, most likely won't, or, I have a good 40 more years of work if I'm 22, 20 if I'm 45. It's actually a good stretch of time. You have time to diversify broadly, even outside of your risk comfort zone, and just make sure that your portfolio is diversified. And by that I mean all the different asset classes. And if you have private investments, like that's the trend, right? People are talking about giving retirement monies opportunities to invest in private securities, then you should figure out, what percentage, but try to have exposure, because diversification is kind of the best overall strategy.
Perfect. And before I would love to get after this section into the conversation of liquidity and what amount you should have before starting investing in, let's say, venture capital, because that's low liquidity asset class, right? 8, 10 years after you see the money, so you gotta have, how we say in Colombia, the colchon, the mattress of money ready to pull out from, right? And and that means, stable income, cash flow, manageable debt. When would you say, both of you, is the recommended time for you to get into this specific industry, venture capital? Because, sometimes people say, like, hey, after 20 years I've worked, I've invested in multiple of their different asset classes, I'm ready to get into this low liquidity type of asset class. When would you say is the time, and how, if you can say or want to say an amount, what do you say is the perfect amount for you to say invested? And I just want to say and add before you respond that question, that this specific topic was generated by one question that you told me, Carlos, a couple of weeks ago, and it was that you usually invest in stocks, and what you get out of that stocks you put into venture capital. So it's very interesting to see, how these asset classes combined work in terms of investment. But I want to learn from you too. When am I ready to get into this asset class? How much should I have in the bank, or what gets me there?
You want to go,
You
Carlos?
want to go first, Adela, or yeah, go first?
Okay. Um, I said it before. If if you're given an opportunity, if the rules change for your retirement monies, which are illiquid anyway without a penalty, because you put your money in your IRA or your 401k, and if you try to take it out before you're 59, you pay a penalty anyway. So those are monies that are not highly liquid for you except in an emergency. And you're given the opportunity to choose among the different selections venture capital, I would, my risk profile, I would have invested in it. I have done very well with a portfolio that's heavily equities, and I would have gone in that direction for sure. And like I say, if it's offered, like I went into internationals and emerging markets, probably when people thought, it was very risky. I thought, well, something could happen overseas that makes it very successful. I think my overall mix of the different asset classes has been very good in terms of long-term results. So I would say you should consider it. Now, if it's not your retirement monies and it's the money that you need to have a certain amount that is like your cash for an emergency, and then your longer term savings. And then when you're there looking at those longer term savings, this is another valuable asset class. It shouldn't be 100% of that money, but should it be 5 or 10% venture capital? Yeah, I would say yes.
Yeah. Yeah, and picking up on that range that Adela mentioned of 5 to 10, in my personal case, just to give a little bit of context. So I graduated college in 1994. I already was dating my current wife. So since the time I was in high school, actually, I knew that I wanted to get married relatively quick after college, right? So that took me into this journey of saving very aggressively and assertively from the early years. And as soon as I got my first paycheck, in addition to the 401ks, and let's say the maximum was 15 pre-tax, I was saving 25, right? Like I was so eager to save pre-tax, post-tax in any way I could. And on top of that, I remember Charles Schwab, and this is not an endorsement, it's well known, right, kind of broker, but Charles Schwab had opened a branch in Puerto Rico back in 94, 95. And I remember my friend and I went and put a trade for Microsoft back then on the phone, right, over the phone. So where I'm going with this is that you have to give time and patience to your investments, while the earlier you start doing it, uh, the better results you can have over a long period of time. Call it the compounding effect, call it the give them better opportunity to diversification, but you really want to start early and invest wisely. Take risk, but understand what kind of risk are you taking, and also understand your windows of time. When do you expect the cash? When do you expect to need it? Under what circumstances? And while it's very difficult to time the market and beat the market, believe me, it's incredibly difficult over a long period of time. That 1% or 2%, 100 basis points, 200 basis points, 300 basis points, while it may not seem like a lot in a single year, it aggregates to be quite a bit over 15, 20, 30 years. So while it's okay to be, devote enough time or sufficient time to your portfolio analysis, don't put it completely out of control or in auto motion or so forth. Because with a little bit of more effort and attention over a period of time, you may be able to get, a more productive result.
I really like what you
Compounding
mentioned
is
emotion.
real.
Yeah.
It definitely is. Compounding is real. I like that. And Carlos, I really like that you mentioned the emotional part, because now that gets us into the conversation of risk tolerance versus risk capacity, right? And people often, and this is my question, people often say that they have a high risk tolerance, right? And you gotta compare it, but how is emotional risk tolerance different from the actual financial capacity? Because I can like a lot of the startups, I can like 20 startups, but how much am I really able to risk on investing on all of those? So that's my question. People often say that they have a high risk tolerance, but how is emotional risk tolerance different from the actual financial capacity to take a risk.
Yeah.
Uh,
Well, with that, maybe I use an anecdote of my coffee cup, right? Like for a number of years, I commuted to Manhattan for work, and I will go and buy a coffee at Starbucks, right? For many years, every day, not years, but after a while, I figure out, I listen, I, I cannot, technically I can afford the $5 coffee cup, right, back then and so forth, but it doesn't mean that I needed or it was bringing me something that I wanted so much that I would spend $25 a week on coffee when there was free coffee at the office, right? So the adjustment there of the 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 fact that I could doesn't mean that I should or I will be okay if something goes south emotionally, right? So to start, and this the way it happened for me, I started in investing as an angel in 2022, so it's actually 4 years now, and I have been investing through Angeles. I'm a limited partner at the fund, and I'm also invest directly in some selected bases, right? But very early, I said, and I determined, and I did it with my wife, right? Saying any money that I invest in and allocate into this asset class is something that does will not affect anything under any circumstances of our retirement plans or financial situation or emotions. Obviously, no one wants to lose. Everyone wants to win. That's fair. But the fact is that it's a risky asset class. And what I told my wife is that the last thing that we will want is to be sour and upset and angry and if for some reason one of the investment will go south, which by the way, that has not happened to me, but the likelihood of it happening is high.
Very
Is high,
high.
right? So
Yeah. Uh, I guess you do have to have that mindset that, and it's in the market, equity markets as well. I mean, recently, the markets are very high, and somebody that works for me, not in the business, she helps around the house. She said, "Oh, do you invest in the market?" I said, "Yes." She said, "Would you help me? I would like to open an account." I asked her how much she has. It's on the low end, but I guess she could, and she's with a good bank. And I said, "Okay." And I said, "But you have to understand, you can lose it. Not all of it, but you could lose. I can't, I never know when is the highest or lowest point. All I know is you get in the market, and almost at any point that you got in, you're kind of ahead, 5 or 10 years later, almost at any point." And she
yeah,
said, "No, I understand. I understand that it's high risk." That's a very mature conversation, and I felt, even though she might have never done it, she has a clear understanding. She's clear-eyed about it. But I think it's important for people to understand that not investing, you have to consider, well, what would it have been had I invested? And for the most part, if you keep your money in the mattress, you have lost a ton of buying power because there's annual inflation and you've fallen behind. So investing is kind of pretty essential. And then you do have to have, like Carlos, a clear sense of your liquidity. I might, in my case, I think I have 3 kids, they always have needs, this. I need to have some liquidity for things that could come up. And so I can't invest beyond that because venture and private equity and some of the other private investments that are very common now are pretty illiquid. And even if I needed them, even in a crisis, they would be unavailable to tap into.
yeah, yeah. And by the way, Yeshua, before Adela mentioned the 5 to 10% rule of thumb, or some indications that which anyone can read about it in the public, material, let's say, of asset managers. But I would say that in my case, when I started, I said I want to allocate a certain percentage, and I'm going to build that up over a period of time. So from an asset class, it was my first experience with a very liquid asset class, right? Like for any of these startups, at the minimum, you probably need 5 to 10 years, and it's getting longer as we know it, right? So the point is, I decided in 22 to allocate up to a certain percentage after the threshold that I mentioned before, right? So I already said, okay, this is my first threshold. And then I say, I want to start building up my portfolio. And I'm talking about portfolio, not individual investment, up to a 5% of a certain threshold. And by the way, if situations change, I know when to adjust on and where, when, where, and how.
Yeah.
Yeah, I think you need to have the ability to handle volatility and uncertainty, right, in this industry, in this asset class. And as you guys were mentioning, just to sum it up, ability to lose the invested capital. I remember in one of the Angeles event, I asked a member and he mentioned, I try to forget I made the investment in case the money goes away, but I'm on top of it to know how it goes like every 2 3 months. But I try to forget I put it some money in it because sometimes you lose it, sometimes you make it big. But it's, you need to have the ability to lose the invested capital. You need to know that you know it's not money that will you will cover family and household obligations because it's money that is illiquid. And and there will be different things, career and income stability, that can affect the amount you invest in this asset class. But I want us to move into, now we talked to liquidity. Now I want to talk into savings discipline plus investable capital. So my next question is, how should someone determine what portion of their savings is truly available for angel investing? So you've mentioned the 5-10. I want to dig a little bit more into this because we've heard the 5-30-20 rule, 5 50 50-30-20. So what do you guys think on on that part for the savings that you need to have in order to start investing and and being able to join this asset class?
Go ahead, Carlos.
Yeah, I'm looking at the survey that was sent to the Angeles
Oh,
community,
yeah,
and
let
it
me
was
see.
interesting enough because when I was saying, well, where do I fit here? And I would say, well, first, we have to pay for our food and shelter and so forth, and anything else is discretional, including the go to the pizza, to the pizza party. And by the way, I will start saving and investing before going to the pizza party, right? That was so the way we were for many many years. That said, I think we pivot at different points in our life, right? So if you think about the life moments that everyone has, those come at different moments in life, different moments in our professional career, different moments in our, in the situation of the market, right? Like we don't time life events completely, and you have the market events that may be to your favor with respect to the life events or may not, right? So you really need to plan ahead and be comfortable. But to what Adela has said before is you have to be steady, right? You need to have a steady hand at the timonel, right? In terms of your cartografía, no, your roadmap as to where you want to get and over what period of time, and understand the turbulences that they may appear and so forth. And by the way, if you get good luck and you get tailwinds and you get beautiful weather all the time, that's awesome. But the reality is that there will be turbulences, right? Whether it's a great the financial crisis or shorter turbulences where there have been, all of a sudden you see a stock market going down 15-20% for whatever reason. And the more we have in AI robo advisors, automatic investors, the more the algorithms react to whatever trends. So we have to be prepared. At the same time, we have to be willing and able to take risk, hopefully to get a better return over a period of time.
Yeah, that's very helpful. I worked for a large company, Smith Barney, for 10 years. So the objective when you're with a large company, and you worked for one, what, 29 years, you said?
Yeah.
Carlos. So it's to take advantage of every saving opportunity there is. And those are very attractive. They have matching of the 401k. There's also health plans that have a savings component to them. You can carry them over and stuff, maybe. So you max out everything that you can. But after working in a corporate setting, I was an entrepreneur. And then the restrictions are much greater. For example, I couldn't just put money aside tax free. I had to have a plan for every employee, which I did because if I wanted to save, I had to save for the employees too. But you know, I couldn't save to the same extent when I had to do it that way, so I was limited. I've always been very tax driven about savings. I want to save everything that reduces my tax rate. I mean, I'm just really extreme about that. So the max that I can, I do. It's hardly ever 20%, I will say. Only now that I don't have a business as an entrepreneur, I have a little bit more latitude now. Maybe because of my age too, they let you save more. I don't know. 20% would have been hard to do as an entrepreneur. I know that. But if I could have, I would have. Uh, Although, you know, I widowed 30 plus years ago. My husband was 40. And he was a believer in we'll do it later, everything will be later. Well, you know, time is now. So I want to also have a certain enjoyment of life and have enough to save to retirement. I don't want to be a burden on my children. And if there's any money left over for them, fine. But I'm not driven by that. I don't care about. I mean, they should. They have great educations. They should figure it out. But I do think it's very important to save. I think 20 for me it seems like a high number, unless you get tax benefits for it. And then if you get tax benefits, try to put as much away, because that's efficient. Think about where you are in your tax rate and how you can promote a lower tax rate for yourself.
Perfect. No, and that's very interesting because it's, separate your savings from the investable capital that you have, protect emergency and short-term reserves, account for taxes and major upcoming expenses that you have. It's very interesting, the discussion we're having now, talking a little bit and going back a little bit to the 5-10% that you both mentioned, for example, Adela, that you try to put into venture. Where should angel investing fit within a broader financial plan? And I wanted to dig a little bit into that. Some people, I met recently a family office that very weirdly, not familiar, they were allocating around 30 and 40% into venture capital, because the head of the family office was all into venture capital, but there are some risks that comes with it, right? So when would you say it is that sweet spot? How can you start growing it as your portfolio diversifies, as your portfolio grows? Because maybe you start a little bit less, 2-3%, then increase it to 5 over the years period, 10%. What do you think is the metric there, both of you? If you want Carlos to start with that question.
When I mentioned 5% as my own personal target, is in part because of all the math, right? As a CFO, I have said, okay, from a family perspective, this is basically risk-based capital, right? For those familiarized with banking institutions, it's like weighted at 100% capital surplus kind of allocation. So with that, what I said is, what will give me the opportunity to build a decent portfolio of companies, right? That is aligned to what I believe on, and the ability to, get enough return, hopefully over a period of time, that will be, I don't say it will be meaningful for me. Let's put it that way, in terms of the effort and the purpose. And the other thing I want to say is that I'm doing this angel investment startup investment with also a personal purpose and affiliation affinity. So the return itself, while the financial return is important, there is a personal human return that I get from my involvement, right? That said, I because it will take so much it will take a long period of time to know what kind of return do I get. My thesis is I started in 22. Every quarter, pretty much, I have been putting seeds to work, and I do it in such a way that I pace myself in terms of the amount per investment. Obviously, Angeles investors provide a feasible way of doing that. But in addition to that, I also maintain enough discipline to say annually I will do it, between this amount and this amount. And in some cases, I mean, in 4 years, I have been in the upper end of the range. In some cases, I have been in the middle. In some years, I have been on the lower end. Part of that is also that I share with with Angeles, my colleagues within the community, my wife, what I'm doing, because there is a certain amount of what we call accountability and clarity. And believe me, when my wife challenges me in terms of what is your, how confident are you in something, then if I'm not able to support it with, the best objective facts that I have, it's not a good investment for me, right? In that sense.
Yeah, those are excellent points. I, I, I did say 5 to 10%. I do think that's given the risk profile of this sector. This sector is high risk, high reward. And with high risk comes, you talked about losses. David and I always talk about this. The expectation in a portfolio of 10 or 20 investments is most of them won't survive because we invest seed, and seed is where you get outlandish returns when they mature, but many of them don't. And the objective would be that you do better than the stock market. And look, the last 2 years, the stock market has returned like 20%, I think. So we're looking to do much better than that, but that's a hard number to break. The long term of the stock market is more like 7%. Look, there are entities like a university endowments and foundations that they do invest 20 to 30%, or like you mentioned, 40, in illiquid private investments, be it venture capital or private equity. But their horizon is hundreds of years. I mean, endowments can go on forever, and so can foundation monies. We have more of a fixed and shorter period, right, that we want to realize returns on. And so it's important to be prudent. I will say that after hitting 65, and you're reminded all the time you have to sign up for Medicare and all that. So I'm very conscious of my age. I do think now maybe I should have more in fixed income, more treasuries, more, because I should be prudent. That hasn't been my profile. My profile is I'm not afraid of the risk. I've been equities, and I've been in venture for over a decade now, I would say. You do venture, you don't even realize it. You have a friend, they're starting something, they ask you for some money, you don't even realize you're making a venture capital investment, and you think of it as just a friends or family contribution. So I've been doing that for 40 years.
Very
And
interesting.
Yeshua,
And
this is where also the portfolio allocation is important. One reason is, if you look at the stock market, and as Adela alluded, I mean, over 30 years of my investment in the public market, the first 10 or so, 15 were so-so. There were some ups and downs. I mean, when I say so-so, average, right? Not, but I stay in the market, right? The last 5 to 6 years have been incredibly prosperous. And for the last two, I made a personal decision to be a little bit more conservative what I had been, but without jeopardizing the opportunity cost, right? But what has happened? The stock market has continued to rally, right?
Yeah.
So, do I am I sour that I could have whatever done better if I had more money invested? No, because I made an informed decision of what to do.
Right.
At the same time, I decided to do a little bit more fixed income, but not the long bonds or 4, 5, 6%, but to try to do some lending programs in a certain structure that will be relatively healthy, but at the same time, I will be able to manage the risk. So again, I guess everyone has to make a decision as to how they want to manage their finances. But what I will say is that if you take an approach as a CFO and a CEO of your business finances, the better chance you have of making informed decisions and factual decisions about the present and the future.
Perfect. No, that those are both great insights. I think what you guys mentioned is very interesting because angel investing should be one component of a diversified portfolio. You know, you should also have public markets, retirement accounts, cash, other assets, real estate, but you should have a little bit of concentration as well on venture capital and planning for multiple investments rather than just one isolated check. And that's why angel investing is very interesting when it comes to these different asset classes. uh, I want to now start getting into mistakes that you've done, mistakes that you've seen other angels do, because at the end, common mistakes future angels will still make. But if we can prevent that, that would be very good. So, what personal finance mistakes do you see people make when they begin exploring angel investing, or when you first started? You committed some, and I'm guessing some emotional mistakes. We all do when we start in this industry, in this asset class. So, what were those mistakes that you typically see that you want and would recommend other new angel investor, future angel investor to try to avoid?
Well, I'll be honest. I've made tremendous mistakes. While the overall result has been okay, I've had breathtaking mistakes. Number one, shorting. Do not short. Shorting is scary as can be because you can lose more than you actually are shorting. You can lose, you can bet that IBM is going to drop and you short it and it can go up to 2000 and you shorted it at 200. How are you going to you could lose everything. So shorting, and I have experienced it and I don't ever want to do it again. The other mistake you alluded to, Jeshua, and that is diversification or lack thereof. You fall in love with a stock or a startup, and that's the only thing, or it becomes such a big part of your portfolio. I've seen this particular, and it has happened to me in healthcare, where they're about to get their FDA, and everybody's, oh, yes, 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 and they don't get it, and the stock goes from 20 to 2. And you own a whole lot of it, and it's gone. So you can do those things, but you really, I have learned, there's got to be a small percent of your portfolio. You cannot put everything in that basket, just the one or the two that you love, and then watch it go down. I've suffered it, and I would just say diversification is key. It's more important than everything else.
Yeah. Um, you know, um, I would say, and I don't know if it's a mistake or maybe a lack of proactiveness. I would say the planning for tax efficiencies of cash flows and waterfalls is important because the earlier you start the planning, the more optionality you may have and flexibility. Not to say that you have to start, you know, overwhelming yourself. But I think that the tax efficiency of your investment is important, as Adela said. And also, what I would say as a mistake, and this is actually in the public market, whenever I have lost in a single name, is because I have violated my own rule. Let's put it that way. And I have violated my own rule in terms of time, and in terms of concentration, in terms of expectation for recovery. That happened to me with some BDCs, or one BDC in particular, Business Development Corporation, where I thought I will be incredibly difficult for so many loans to go bad 100% within a portfolio. And that has happened. Needless to say, the BDC is in litigation, right? There is a legal case going on. I will not say the name. But the point is, stay true to your discipline and rules, right? And those rules, some of them are almost like philosophical principles, and some other are the tolerances and the specific thresholds within the rule. But stay true to your rules, and tweak your thresholds accordingly, but always toward the same principle of your rules, right? But I
Great.
violated a concentration in a single name of a certain asset type, and I lost 60-70% of the investment.
No, I would only add the investing because of excitement, and that happens a lot on this asset class in angel investing, venture capital. I have one personal rule is that if I cannot explain it to someone in simple words, I don't understand it enough to be capable of writing a check. And you know, sometimes you fall in like excitement. No, I'm gonna change the industry, new chips. I'm gonna get over Nvidia. I'm driving the next generation. If I don't understand it, I think that's one axis or social pressure as well. We always have a cousin, nephew, or something that has the new generational idea, and sometimes you gotta be careful with those in terms of this type of asset.
Yeah.
And
And the
and
same
and,
happens
and
with highly leveraged ETFs or positions, right? I personally, my grandmother said, don't owe money to anyone, and not to take that, but you want to really have good credit, right? Or highly efficient credit. And on the asset side, be careful with the instruments that you invest. Highly leveraged ETF, for example, or they may bring a return of 2, 3, 4 times, but the level of risk is exponentially higher, right? So you have to be wise and informed about that.
yeah, definitely. and as another example, SpaceX. A lot of people fall for the excitement. Need SpaceX going public. They bought at the 135. Even I think it got to 165, 70, and right now it's 126. So be careful with that excitement that the market gives you. Now I want to finish the webinar with just one simple question, and it's about a checklist. What's like a personal readiness checklist that would recommend a future angel investor they have before getting into this asset class? So the question is, if you had to give a future angel investor a simple personal readiness checklist, what would be on it? What would you like to have received as a checklist from someone else and as an expert in the industry when you guys started? Adela, if you want to start.
Well, Carlos mentioned it. You can't, it can't be funds that you need for housing, the kids, school, tuition. It can't be that. So it's got to be extra funds that you want them to be there and grow for a good retirement or something good in the future, but it's got to be forward looking. You got to be able to say, this is money that can sit there, I can lose it, I got to be ready for that, or wait for it 10 years. If it doesn't fit that criteria of patience, you can't do it.
Yeah. I mean, we have alluded right on what Adela said. That's probably number one in my list. I would say something like I will definitely not get into the asset class if I will not be able to have a, 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 a bigger purpose than just investing. I mean, when I think about the returns relative to risk, relative to liquidity, all that kind of stuff, for me, I truly believe in what I'm doing from a personal perspective. At the same time, I think we have to be willing and able to be on it for a long period of time, because to separate, 50,000 in a single startup or in a couple of startups, it may go well, but it would not give you a real sense of whether you can nurture a portfolio, right? Like it's almost like a hitter, and I can go and hit a home run just because of luck, which is great, but I'd rather be more systematic about it. That's why I deploy in relatively small amounts, all things considered. If I had a bigger wallet, maybe I would do bigger amounts, right? But I want to be conscious about getting enough turns at the bat and planting enough seeds.
And that's what I love about Angeles. We give you an opportunity to invest just small amounts together with other people, and that enables you to diversify the risk, as does the fund is fully diversified. And that's rare to be able to do it at this level. Most venture capital investments are 250 to 500. I mean, the other day my friend was saying, oh, they know me and they like me, and so I can invest just 250. And I'm thinking, oh, okay, that's a lot, because the minimum is 500. So it, I'm proud to be able to work on this team with Carlos, with Jeshua, with David, and others, to bring an asset class that's generally for the very rich, that generally provides outsized returns to all of us that can even talk about it, can be in a position to do small investments in this area if we want to and if we can afford the risk.
Now, and we'll, with that, I think we've finished and we've gave enough insights for these future angel investors. So I wanted to thank you both, Adela and Carlos, for joining us. I think as a central takeaway, I'll say that becoming an angel investor does not begin with finding a startup. It does not begin with building a financial. It begins basically with building a financial foundation that allows you to and someone to invest patiently, responsibly, and without compromising your broader financial security. That's where you start as a startup investor or angel investor. So again, thank you, Carlos. Thank you, Adela, for joining us. Great insights, and I'm pretty sure the audience really liked your insights.
Yeah.
Thank you
Uh,
both.
Yeah, it has been a pleasure. And Yeshua, again, this is my own personal journey, and I'm honored to be next to Adela, who has been has a lifetime in being successful in this space. But again, I think this personal journey is important to undertake it relatively early. Again, first things first, in my view, like what you prioritize, but once you start seeing the opportunity to look beyond the first starting points of investing and savings, or even and investing, you can start looking beyond that, right? And start evaluating how you will learn about those ecosystems or those mechanisms or those opportunities, right? And learn by doing, to some extent as well, and that gives you some pragmatic experience.
Thank
Wonderful.
you.
Thank you both.
Well, bye bye.
Bye bye.